Welcome to the FinTech One-on-One podcast. This is Peter Renton, chairman and co-founder of FinTech Nexus. I've been doing this show since 2013, which makes this the longest-running one-on-one interview show in all of FinTech. Thank you for joining me on this journey. If you like this podcast, you should check out our sister shows, the FinTech Blueprint with Lex Sokolin and FinTech Coffee Break with Isabel Castro, or listen to everything we produce by subscribing to the FinTech Nexus podcast channel. Before we get started, I want to tell you about the many opportunities you have to reach the FinTech Nexus community. We have an entire suite of digital products that includes webinars, in-depth white papers and case studies. We have advertising opportunities within our newsletter, website, and podcasts. We also do sponsored articles, dedicated emails, and much more. We can create a custom program designed just for you. If you want to reach a senior FinTech audience, then please contact sales@fintechnexus.com today. Today on the show, I'm delighted to welcome Rodney Williams. He is the president and co-founder of SoLo Funds. Now, longtime listeners will know I got my start in this business, in FinTech, via peer-to-peer lending. I was an investor on peer-to-peer lending platforms. So this is an episode that's really close to my heart. I love what SoLo Funds are doing. They don't call themselves a peer-to-peer lending platform. I think that's intentional. They call themselves a community finance platform. But as you'll understand in this interview, that's really, they've taken sort of the core of peer-to-peer lending and brought it to life in a mobile app. And we obviously talk about exactly how it works. We talk about the borrowers. We talk about how they make money. We talk about their regulatory challenges and how they're overcoming them. And we talk about their investors, their international expansion, and much more. It was a fascinating discussion. Hope you enjoy the show. Welcome to the podcast, Rodney.
Well, thank you for having me. It's a pleasure.
Okay, my pleasure as well. So let's kick it off by just giving the listeners a little bit of background about yourself. Looking at your LinkedIn profile, interesting time at a consumer product company, the Procter & Gamble, that you started your career there or early on in your career. Why don't you hit on some of the highlights to date?
Yeah, well, I definitely started my career at Procter & Gamble, intern to brand manager. I was a brand manager and an intern. My entire career I've spent at Pampers. Interestingly enough, when I first started at P&G, they tend to ask you what brand you would like to be on. And everyone tends to run towards the more exciting brands. As you can imagine, maybe Gillette or Old Spice. And I asked my lead at the time that I want to go in a brand that could use me or could leverage my skills. And they then decided to put me on Pampers. And I was so confused. I was really confused because at this point, I'm a pretty young guy.
Yeah.
I don't have any kids. And I'm like, Pampers out of all places. But what they had a challenge with was that new moms the new mom segment was the most digital market segment in the entire company because new moms gravitated towards online resources for help the moment they even had the idea that they may be pregnant. It's like searching for signs of pregnancy, right?
Right.
And also the fact that most don't know that Pampers is P&G's largest brand at that time.
Huh. I didn't know that.
By far, it was hovering around a $13 billion brand globally and a $6 billion brand in the US alone. So, and it was like two massive gorillas in this market segment, which is Huggies and Pampers. In their words, their brightest and their best went to Pampers. And that was where I was trained. I was trained to not know the consumer based on my personal experience, but to understand the consumer based on research and consumer insights and kind of diving into the things that the consumer needs. And that's been my training ground. So that's where I started my career. I then went to start my first company, which was called Listener. I was actually incubated by a P&G funded incubator out of Cincinnati, Ohio. It was called Centrifuge. I was the first centrifuge company ever. Literally went from one P&G office to another P&G office. And I did that until SoLo Funds. That company, largest investor being Visa, it ended up starting in an engagement kind of marketing type of product to a security payment financial technology product. And I know that's difficult, but to tell you what listener is an ultrasonic data transmission product. It's an alternative to NFC for mobile payments. It's an alternative to the QR code. And to be transparent, it's significantly better, more secure, more universal. But as you can imagine, there's a lot of parties that are much more influential than a little company out of Cincinnati, Ohio, in terms of what's going to be used at the device level or what's going to be used at the software level. Despite that, that technology today is used in about 12 countries for mobile payments. And some countries have penetration over 80%, like Angola. It's rapidly growing in Nigeria. And that company is live and well today. So, as I kind of was leading that company, to be transparent, I still would go home to my friends and family who weren't at the same financial level as myself. And I then took on the burden of the family member who would, everyone would always ask me for loans. And it was $50 and it was $100 and it was $2. It was $200. And I remember thinking to myself, is this just a problem amongst my friends and family, or is this a greater problem? And I think with a little bit of research, it was a much greater problem. And then I started to really think about my family's position and the way my mom, and the way I grew up, and the experiences that I had when things would go short. And she would then have to meet loans, and she would need to go to the post office to turn back on the utility. Or if you ever been into a payday loans, right? You can go to a check cashing place and actually pay your electric bill, and all of the different fees that would then be added on to these types of scenarios. I had a very, very intimate knowledge. And that's what some of the premise that started SoLo. My best friend, Travis Holloway, my co-founder, he shared an alternative experience, which was really his father working at General Motors for 35 years. He was a financial advisor, and he could never call on someone like his father because they were deemed not to have net worth, enough net worth.
Right.
So, he's looking at an entire company focused on driving investment options for a group of Americans that his father was not included in. And that's what kind of gave him this concept that if we want to create a true community finance product, you can't just provide access to capital. When people do have capital, you have to give them the opportunity to grow it as well. You will never change their financial position if you don't do those two things. And those two groups are more similar than any other group. And that's the concept of what we've ultimately do by putting these two groups together.
Right. Interesting. Okay. So then why don't you explain exactly what SoLo Funds does and how it works?
SoLo Funds allows borrowers to make a request for short-term capital. It's roughly up to $575. They can choose how much they need, when they're going to pay it back, and how much they're going to pay. It's 100% voluntary and optional what they pay. When they sign up, there's no credit check, there's no approval or denial. Users just connect their bank account, and then once they connect their bank account, they make a request. Our request system is a ladder system. When you first come into the platform, you only can request up to $100, and then it increases in $50 increments as you pay on time. If you pay late, it will decrease. That's as simple as the request flow I can explain, but super simple. The users clearly understand what they're doing. On the lender side, the lender can scroll a marketplace of requests. They can see how much that consumer needs, when they're going to pay it back, what's the reason, and ultimately their tip. So what a consumer chooses in terms of what they will pay is a tip that goes 100% to a lending member and a donation that goes 100% to the platform. There are no mandatory fees, no verification costs, no transaction costs, what I'll call no subscription fees, no annual fees. It's literally to request that loan and to receive that loan, there's a tip and a donation. Borrowers choose those and lenders choose who to fund based on those tips. Right.
Got it. And as I said in my introduction, I've been an occasional investor on your platform now for a couple of years. I have funded, I don't know how many, a couple of dozen or so loans over that time period. And it's a very simple process. That's the thing I like as a lender. I mean, I can literally be in and out in 15 seconds, funding a loan. If I don't want to read all the details, whatever, it's very, very simple. So a borrower comes on, opens an account. You said you don't do any credit checks. Do you do any identity checks, or is there anything that's going on before they're able to ask for money?
Yeah, one of the things that we do that has naturally worked as what I would call like a security measure is that there's essentially 3 verifications that's required to be a member, mainly because we actually meet all the requirements for a user to start a bank account to actually access SoLo. We actually do create a consumer deposit account in each user's name. So what I'm referring to is that you have to meet all the AML and KYC that's required to start a bank account. So that means we do collect things like ID and other personal information. It is a pass-through to our partner. The second piece is that we do connect to your Plaid, via Plaid, your external bank account. So your external bank account is where we take into account your cash flow history. And that's what we use to create your SoLo score. It's super simple. The more activity you have, and generally speaking, the more that score will reflect that activity. As you create that score in the beginning, the highest that a borrower can get is a 60. And because the rest of the incremental ability to increase your score only can happen once you start paying on time. But the third and final verification step is actually a debit card verification, where you have to add a debit card that not only matches the account that was just set up, but also matches the external bank account. And then we do micro deposits to ensure that you have ownership into that Plaid external bank account.
Okay.
Those 3 kind of verification steps, as you can imagine, you would think, wow, that's kind of a lot to get a loan. But number one, I think our conversion since the beginning has been around the 30% range for borrowers. I actually, when I look at the entire lending industry, when I see the lending industry don't do the amount of verification that we do, I wonder why. We do that much verification because it's super important for us to understand who they are. We have to stay connected to them. And if this borrower, the best thing that you can do to a borrower is help them repay,
right?
Not expect them to repay. And that's one of our philosophies if I kind of get into the rest of the product. But those are the ways in which we verify each user and sign them up.
Right. Okay. And obviously, I know people use this a lot. I mean, the borrower that I actually have a loan out with right now, I think she had 35 loans. She was a 99. Those ones don't stay on the platform very long. Anyway, so she's obviously done a lot of loans. But I'd love to kind of get, what is the typical borrower? I mean, I imagine 35 loans is probably not typical, but I'd love to kind of get, if you could maybe paint a profile of the typical user and how often they use the product.
Yeah, a typical borrower is using the product about 5 loans in a 12-month time period.
Okay.
That is the typical. Because the duration is really low, I'm going to tell you another interesting stat. The borrowers who tend to use the product a lot more, what we are learning, they are using it. And interestingly enough, we have some evidence that they're using it to kind of maintain a business. And I know, some people may say, well, how does $500 every 2 weeks maintain a business? There's things that we're learning. For example, there's a person who is on our platform who borrows to maintain their inventory of their e-commerce business online. So they basically sell about $500 worth of products every 2 weeks, and that's their business. We have some information around some Uber drivers who tend to leverage all of their gas and all of their car expenses, as an example, so they don't have to kind of eat into their operating capital. Again, I'm always amazed at the need for short-term capital. It's much greater than what we initially thought. But on average, you're talking about 5 times a year, which is less than payday loans. The average payday loan user uses about 8 loans per year. And then if you think about cash advance companies, users tend to use them a lot more than both. That's the kind of the example of the industry.
Right. Interesting. So then what about on the other side of the equation? Who are these investors? And do many of the borrowers kind of graduate to be investors?
Yeah, 30% actually graduate and become investors, which I'm very, very excited about. Just my favorite stat. And I think one day we're going to get that to 50% with some of the products that we're going to be launching, because again, that's the power of community finance. But today is 30%. Our borrowers tend to be around between $35,000 in salary up to about $100,000. It has increased over time. When we first launched the product, I would tell you that the top of the ceiling used to be around 55,000. It has increased significantly over the past 24 months. 10% of our borrowers make over $100,000 a year.
Wow.
This concept is kind of greater, and that person, to be very clear, who makes about $100,000 a year is very sophisticated, has credit cards, understands APRs, and again continues to use a product like SoLo because they have also determined how affordable this option can be, how flexible it can be, and how easy it can be. So there's a lot of advantages in that, but that's who our borrowers are. On the lending side, they tend to be around from 75,000 in salary up to around 150,000 in salary. They tend to still be relatively close in proximity in terms of location to our borrowers. So 82% of those members, total members, actually live in underserved zip codes. We're very, very proud about that. So that's ultimately maybe, the small business owner in that neighborhood. It's the person who lives in that neighborhood, but older, a little bit more, has a little bit more tenure in their career, for example. So they've kind of gotten a better footing, but they're very, very similar to each other. And the way I like to describe both our borrowers and our lenders is that they're everyday Americans. They're the working class of America. They're the barista that served you coffee this morning, the Uber driver who took you to work. They are the mechanic, the janitors. I always say if I look at an office building, it's the group who's running the building. It's not the group that's working at the building, if you think about it that way.
Right. Interesting. So then platforms like yourselves, obviously you have to balance the borrowers and the investors. How do you maintain that balance? And are you typically overweight on one side or the other?
Yeah, honestly, from a lending perspective and a default rate and a repayment rate, we have outperformed every other investment option since 2019, since 2020. I know a lot of our predecessors have had a ton of problems maintaining one side of the marketplace over the other. I think transparently, I think we've unlocked something very, very special with the short-term nature, which has allowed flexible access to people who need it, but also we have created something who has created a return to everyday Americans that they would otherwise not be accessible, like they wouldn't have access to. The average lender on our platform can clearly make more than 12% annually. The average lender can make over 20% annually. And where else can an everyday American decide to put their capital, make a social impact, and make a return? They don't have enough information and awareness and education to be great at DIY stock market investing. I promise you they don't. That is a market that is much more complicated than whatever Robinhood could provide. I would tell you, crypto and NFTs, unfortunately, middle-class Americans took on the burden and they suffered the burden. Right. To be transparent. If you want to be, if consumer protection agencies want to be accurate, that's what happened. I know, and the reason why I know, because my family was taking advantage. My barbers, they thought that they were putting money in crypto coins and things that they were going to be quick, rich schemes, and their few $1,000s were lost, and they're never going to get it back. So when you think about everyday Americans, what options do they have for yield? Maybe a savings account, maybe Apple savings account. Kudos to Apple. That's fantastic. We all know that depending on your net worth, I can get a significantly greater yield than that, right? On average. And this is the example of the problem that we're trying to fix. The reason why our lenders have gravitated towards lending on our platform is because the learning curve to actually become good is really small. The learning curve to actually figure out how to create yield for yourself is small. And it helps you can create that, I guess, strategy and deploy it relatively quickly. It takes the average lender around 3 to 4 weeks of lending to have a positive return and be able to consistently maintain that positive return. And then as it relates to the borrowers, unfortunately, the group that needs short-term lending, people used to think it was just low income. Then I think it was clear that it was middle class. I think people are just really confused that 10% of our borrowers make over $100,000 a year. I think that's now shocking. But what we have learned is that cash poor doesn't mean no cash in savings. Cash poor actually means that it basically means in a given 30-day time period, your income is going to be lower than your bills, right? or it's going to be relatively tight, meaning it's break even to negative. And that margin of error is so tiny that whatever you have in savings can be wiped out pretty quickly. So, for example, when we see someone who makes about $100,000, they will have $2,000 to $5,000 in their bank account. The problem is their mortgage is $4,000 or $3,000, or their rent is $3,000. They drive a car that's $700 a month. So the problem is when something happens to their car, it's not $100 tire, it's a $700 tire.
Right.
And so their $22,000, $3,000 gets wiped out just as fast as someone who only has $100 or $200 in savings. And the major difference is that the person who has a lower income, when they get a $500 loan, it may be able to cover a good portion of rent or the expense. When someone who makes $100,000 gets a $500 loan, they're really just trying to cover a trip to the grocery store.
Right.
In between this moment for their family. This is not fixing their problem. This is just covering a moment in time.
I want to switch gears and talk about regulation, because you've had some challenges over the years. Some state regulators, consumer groups don't like your business model, but you have had some recent wins as well. So tell us a little bit about where you stand with regulators today, and what is the pathway for you to kind of become not in anyone's crosshairs?
Is there any financial institution in the United States not in anyone's crosshairs?
Maybe not. Yeah, fair point.
Yeah, one of the things that I like to be clear about, our product and every product, is that according to our current financial system, every successful financial service company is facing scrutiny. I don't think any regulator or any consumer advocate group has selected any specific financial service company as the benchmark. From a culture, I think the regulatory culture of the financial service system is to restrict and is to penalize and to what I call legislate by enforcement. That is the current culture of our financial service system, which, let's just talk about our financial service system, because I think it's really important. It's created the largest wealth gap in the history of America between low income and high income, or minorities and non-minorities. It's the largest it's ever been. What I'm saying, I'm going to say it directly. Black, brown, and women have less wealth today than they've ever had in the history of time as it relates to the United States. Our financial system was built on discriminatory regulation many, 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 many years ago. And all that has happened over time is some unraveling, some policy making, some things to correct those things. But in a nutshell, the financial system as a whole is relatively the same financial system of 50 years ago. Right. And that's the problem with our current financial system as it relates to everyday Americans and people. My next thing, and I can answer this question for 1,000 ways, but I would tell you what our financial system does is they create really great products for people who have money. They don't make any products for people who don't have money. And that's the challenge. That's the challenge that we're facing as an average American, is that's how products are made. So if you're going to make a product for people who have limited cash flow, you're going to do something very, very different. And that's what SoLo has done. So as this relates to our specific regulatory challenges, honestly, they're in most instances, number one, I'm thankful to the regulators in Connecticut and DC and California for giving us an opportunity to share our perspective and giving us a pathway for it. Because that's what they did. They came, they said, you know what, there's some things that I don't like. There's some things that I don't have an issue with. But if you make these changes, generally speaking, we're going to be okay with you operating as you operate. And I think that what in itself gives me hope for regulators as a whole, that that's how you should assess things that are making an impact in your community. That's my hope. So I'm happy about that. I am even happy about, for example, in the state of California, I'm not sure if it's public, but I have no problem sharing it with you. We have a positive opinion on a evolution of our product. That is technically a new product that is going to be added to what we do today. That's going to allow us to automate our lending. So basically today, each person has to go in and actually individually lend. And if you have done it, you will get fatigued at some point. And so it's going to be a product that you're going to be able to take a large deposit, set risk preferences, and it will automatically lend on your behalf. It will be a product that will be technically significantly better for a lender in terms of risk. It will have a lot less risk. It won't yield as much as an individual lender, but it will yield a market leading yield. And then on the borrower side, there will be a lot more automation. So we're very excited about the states that have gone in and kind of said, hey, how can I work with this company? This company does seem to be doing something very positive, and we want to see this company survive. So I'm thankful for those states. I would tell you, as it relates to policymakers, we started spending our time educating policymakers and legislators. This is about education, and more than anything, this is about awareness. It's impossible for a consumer advocate group to go on our website, to read a review, or to read some article from someone who believes they're an expert and understand what we do. That's one of the most number one challenges that we see when we talk to consumer advocate groups. I'm like, did you really use the product? There's one in particular that comes to mind, and I'm like, I don't think you I don't think you've used the product. I do believe you've read some things about it. I do think you've done a lot of online research about it, but I do not think you've used the product. And it's just, these are the nuances that I understand. I mean, you have consumer advocate groups and regulators staffed to a minimum. They're not staffed well, and they're expected. It took us years to build this product.
Right.
We spent hundreds and hundreds of $1,000s of legal fees before we ever wrote a code. So to think that 2 to 3 hours of reading it online, you would understand the nuance of how we built this product, the intention, the legal precedents, and to come to make a drastic headline conclusion that this product is not good is absurd. It took the B Corp, to give you perspective, it took B Corp roughly 10 months to approve us.
Right.
And this is 10 months of bi-weekly meetings and diligence to understand the nuances, not just what we say on websites, not just emails, but going through our financials, looking at the product, using the product. I mean, it just takes some time. So number one, I think, I'm excited about the regulators and the consent orders that have been in place. I think when I look at the rest of the state regulators, I'm hopeful that with awareness, you'll be able to see what we're doing and understand the good, and then figure out how we can work together. And then I think my message to the consumer advocate blitz, honestly, is that it's a new day. For the first time ever, a marginalized community member has created a product that is working, and is working better than traditional players. And I think to live up to your purpose as a consumer advocate, you need to do the diligence to understand why. Mm-hmm. Not understand what's wrong with it, understand why it's working. And that's my challenge to consumer advocates. Understand why it's working. And then we should have a healthy conversation. That's what I'm looking forward to.
Yep. No, that's totally fair enough. And I do remember, I don't know if you remember, like a couple of years ago when we had a big call with your legal team, because I wanted to know your legal approach, because there was a lot of criticism that had been leveled at you, and I felt like you hadn't been able to, answer a lot of that. So anyway, I got comfortable with that, and I'm glad that, as you said, some of the states are getting comfortable now as well. But I do want to make sure we cover how exactly SoLo Funds makes money. And I know you're a B Corp now, but still want to make sure we cover what are the revenue streams for SoLo Funds.
So here's our challenge, but this is also why we became a B Corp. Historically, we've been operating at about a 23 to 26% margin. It's really, really low.
Yep.
So after you criticize us and you go to our financials, there's nothing there to get. So good job. Because if you know anything about fintech and financial services, everything that I just mentioned, even the sign-up process, our sign-up process is about $3 to $5 process. Even the way we move money, we do not use ACH. We use push and pull payments. It is the most expensive transaction. It's to complete the loan and repay the loan. That's like another $4 to $5. So long story short, and there's many reasons on why we built it this way, but we operate at a slim margin as it relates. We have improved our margin over time, but that's really around driving our COGS down and changing the structure. There's essentially 3 ways in which we make money, and this is how we communicate it to investors. Number one is the revenue that is associated to the onset of the loan. That is a donation that is 100% optional. And then we have our product called lender protection. That is lender protection fee. That is the lenders pay lender protection fee. As you can imagine, the donation is self-selected by the borrower, but a lender actually fronts and pays that on behalf of the borrower. So that's a nuance that's super important. Our second bucket is buckets that's related to our payments, money movement. And it's hyper focused on money movement post delinquency. So post delinquency, we do charge to recover those funds, and we're charging the transaction fees, and we charge the lender a fee to recover those funds. So that's basically post delinquency. So it's prior to default. So it's not like we're not in the debt collection era. We're in just a recovery time period. And then the third piece of how we make revenue, which is the fastest growing piece of our revenue, to be transparent, and it's how we've always pitched. What we've always said is the first two pieces of our revenue, the onset revenue as well as the recovery revenue, is basically marketplace revenue. And think about our marketplace being the borrower and the lender. That essentially, the marketplace, we're going to operate that pretty break even. Our goal is to not make money off of lending and borrowing. We don't feel like we need to. But we believe that to build a better financial institution, you have to provide a better lending product and a better yield product. And basically that marketplace provides those two things. But what we've been spending a lot of focus on, especially the last 12 to 15 months, is our banking revenue, our transaction. We call it banking revenue. It's basically the revenue that's attributed to a lot of the ways in which other neobanks make revenue. It's float, it's interchange, and it's transaction fees from leveraging our SoLo wallet like you would a standard bank.
Right.
So, and if you think about this from a margin perspective, the marketplace is paying for the business and making it break even. So when we add on additional banking services, given that essentially the bank account is already there, it's high. These are high margin solutions for us. That's our business model.
Right.
Here's our example. In today's economy, in today's financial system, the financial system wants you to be a lender. And then there's a separate company that is a payments provider. And then there's a third company who is a debt collector. So there's three to four, maybe even five companies that tend to be involved when servicing a loan. And that makes it really, really expensive. What we have said is if you build an entire platform, right? And if you can not just provide the loan, you can provide the money movement, you can provide the bank account in which those funds will sit and then operate. And then you can also manage the repayment process. If you think about it from an entire platform perspective, it becomes a significant cheaper product. And that's where we've driven efficiencies. This is what I would tell regulators, because what much more educated and folks who have been at table, they're looking at the wrong thing. If Bank of America says it's too expensive to provide these subprime products, I would then tell them it's too expensive because you're thinking about it as a loan. We don't think of it as a loan. We think of it as an thing. When someone comes into SoLo, they're coming onto a community finance platform that manages the entire lending, borrowing, and banking experience as it relates to this access to capital. And that has allowed us to kind of share costs, kind of spread them out, but at the same time provide something unique. But that's how we make money.
Gotcha. Okay, thank you. I want to touch on investors, because I know I saw Serena Williams' company or investment company invested in you earlier this year. So who are some of the investors backing you?
I would like to start off with the Black women investors. We have them all.
Right.
And I kudos to them, from Serena Williams and Serena Ventures to Rain Ventures, who Rain Ventures is Monique Idolet and Erica Dunnigan, to the largest Black women fund, and Kesha Cash. Her fund is called Impact America. And here's the insight on why that's important. Do you know who's the number one lender of a payday loan or cash advance or any subprime product?
No.
It's African American women. So what I'm really referring to is that we tend to attract investors who have an intimate awareness of the good that we're doing. So they don't necessarily need to read the publication to understand. They can do their own diligence and actually determine their own value. That's important. I would tell you Acme VC. Acme is formerly Sherpa Capital. Acme led our Series A. Acme were early investors into DraftKings, Robinhood, Uber. they love marketplaces. And when they met us and they did their diligence, they had never seen marketplace engagement like they saw with SoLo. So kudos, they have been incredible marketplace investors for us and to help us to understand the nuance of our consumer experience. And then finally, Richard Lou Dennis. Richard Lou Dennis, I swear we got to talk more about Richard Lou Dennis. There's been so many times in this journey that we have ran out of money. And I mean, really, where like we didn't know how we were going to pay payroll. And Richard Lou Dennis led our seed round, and he's continued to step up for us. Richard Lou Dennis is he's the investor behind a family fund called New General Markets or New Voices Family. He's created his wealth by selling. Number one, he created his wealth with one of the first benefit corporations called Sundial Brands. It was in the CPG space. That company was sold to Unilever. And he's been a prolific investor across a number of products designed to kind of change America in a good way. And he's continued to believe in us. So those are some of our investors. I would tell you, we don't have the traditional stand. We have none of the guys who show up at your conferences, Peter.
Right.
and I'm really referring to, who's your marquee like fintech investors, the QEDs of the world, the Nikes of the world. No, they got too burned with Lending Club. They're scared. They're fearful. The folks at that then maybe invested in Lend Up, for example, they're so nervous. How can two African American males navigate this regulatory infrastructure? How did they figure out something is good? This thing has to fall apart at some point. And what it's doing, Peter, is the complete opposite. We're literally about to pass 2 million users. We announced 1 million in January. If everyone can do the math of our growth rate, we're crossing over 2 million. We're not even going to announce it because it's like, we're wet, right? We've already crossed over 1 million consumer deposit accounts. Back to our SoLo wallet. Back to the fastest growing portion of our revenue is our neobanking revenue, right? So these are the things that the company is doing. And then finally, it's probably going to be your next question of Nigeria.
Sure. Tell us about Nigeria.
I will tell you, we traveled a lot prior to making this company. And a lot of the things that the way we designed this company is we actually learned about microfinance and we learned about community finance in places like Nigeria, Africa, and Southeast Asia and India. We did a lot of research on microfinance. And everyone said microfinance would not work in the United States. They said it's not needed in the United States. We were like, that's not true. If I get another request for $20 from a school teacher who's my aunt, I know that it could exist here. Us going to global, Nigeria has been something on our radar for some time. We started the diligence on Africa as a whole, as well as South America as a whole 2 years ago. It became pretty apparent to us that United States was going to be the hardest and most scrutinized market for us to operate. And it will be our bread and butter, and it will be our foundation. But for us to protect the viability of this market, to us to also meet our true goal was never to provide a solution for everyday Americans. Our true goal was to provide a solution for the working class global citizen. The working class people around this world do share in the fact that they don't have access to capital, and when they do have capital, it does not grow. It does not grow. Wealth is hyper concentrated in an area where we need to disperse it. So for us, as we kind of assessed Latin America as well as Africa, Nigeria quickly continued to be a place where the fintech infrastructure was attractive, the user base was attractive, the dynamics in the macroeconomic environment was attractive. And we also have an investor out of Africa who is the second largest private equity company in Africa. And we, prior to ever even launching, we were able to meet presidents, we were able to meet regulators, we were able to meet bank partners. I mean, we've been able to meet. I give you an example. This is a bad example, but hear me out. Maybe everyone that's listening will have a giggle. When you start a financial service company in the United States and you're doing something new and you hire a bunch of lawyers and they give you an opinion, then you build your product based on your opinion. And the opinion is interpretation, and it can change based on administration. That's mere fact. Also, if you think about regulators like police. Different police departments share different strategies.
Mhm.
That's kind of how regulators are. They are not all equal. Now, what they say is, well, before you launch, why didn't you reach out to us? Why didn't you come to us? That process is really, really difficult. It's in our beginning days, we tried so much to get the attention of certain departments, but no one wants to talk to two kids in an accelerator in Kansas City, Kansas, about a product. It was really difficult. So what I like about a lot of these markets, and maybe it's because the company exists already, who cares? We have been able to talk directly with regulators and get direct feedback about what they like and what they don't like and how we're going to work together. And Africa as a whole has been a market that's been so welcoming to this concept of microfinance and so welcoming to the concept of people helping people. And there's other countries around the globe. Long story short, yes, that's what I'm saying.
Okay.
Peter, if you think, and I know that you have your, and thank you, because when we actually look up to you and your organization as, especially from a peer-to-peer model. I believe many of your insights about how powerful it could be were accurate and correct.
Mm-hmm.
And I'm thinking about the history of fintech nexus. I'm talking about the history, guys. If everyone should know the history. Maybe Peter's going to talk about the history.
Right.
But your roots started in peer-to-peer.
Yep.
And the only thing that they did wrong was that they used peer-to-peer to fix the prime market.
Right.
And we used it to fix the subprime market. That's the one mistake they truly did. And that's the difference. This is a product that's designed to fix the bottom half of the market. And that's globally.
Right. Well, that's a good point to end it on, Rodney. We've gone over time. Great chatting with you, though. Really appreciate you sharing all the insights. It's very important work, and I wish you all the best.
Thank you so much, and thank you for going over a bit.
Well, I hope you enjoyed the show. Thank you so much for listening. Please go ahead and give the show a review on the podcast platform of your choice and go tell your friends and colleagues about it. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye.